I'll show you how you could save up to $46,700 in taxes on various investments and assets using several images, examples, and videos throughout this entire presentation I'm sharing with you on here. So if you have an IRA, a 401k, a TSP, a pension, your social security benefits, or other income sources, this is a must-watch video for yourself to utilize so that you too can retire earlier, retire wealthier, and retire happier with greater financial freedom. This is also a tax strategy that majority of people already qualify for. They're just not even aware of it or sure how to qualify and use it correctly in their own investments and assets. This is also a must-watch video with what happened here in July of 2025 with the One Big Beautiful Bill Act, OBBBA, and I'll be going over that tax changes and tax impacts as well throughout this video. Now, my name is David Lumbert. I am a fiduciary financial planner and tax strategist for over 10 years now. I do hold 2 master's degrees, a certificate in financial planning, and a Marine veteran and owner of Awaken Financial Designs. And I'll be going over more so in this video that if you are married filing jointly, this is even more advantageous to yourself in addition to other criteria that I want to help you out with. Now, the tax code talks about something that's not so private. It's called the Standard Deduction. Now, the Standard Deduction is something that so many people are not aware of how to qualify and properly use it, or how the new law that just passed in July can be better offset with that Standard Deduction as well to keep more of your money from those investments and those assets. So today, we're going to dive deep into images, examples, and how you too can utilize a standard deduction to have greater wealth for greater financial freedom with that standard deduction. Now, as always, it's education only, not direct financial, tax, or legal advice. I would so greatly appreciate it that if you do like this video, please like it, please comment, please subscribe so we can help get education out there to so many other people too. Now, to understand first what is the standard deduction, we have to go into the basics before we can go on the building blocks. We're going to pull up an image here now from the IRS, and we're just going to read what exactly the standard deduction is according to the IRS before we break it down for us to understand. The standard deduction is a specific dollar amount that reduces the amount of income on which you're taxed. Your standard deduction consists of the sum of basic standard deduction and any additional standard deduction amounts for age and or blindness. In general, the standard deduction is adjusted each year for inflation and varies according to your filing status. Whether you're 65 or older and or blind, or whether another taxpayer can claim you as a dependent, the standard deduction isn't available to certain taxpayers. You can't take the standard deduction if you itemize your deductions. So now that we know what the IRS qualifies for as a standard deduction, what does that really mean to you? How can you really use that in your own situation on here? Well, in short on here, when you have, say, a W-2 job and you're making $100,000 a year or $200,000 a year, you get a standard deduction to help reduce or offset some of the income to pay less taxes. Same thing is in retirement. When you take money out of that 401k or that IRA or TSP, that's counted as income. Even a pension is counted as income. You can use the standard deduction to help offset some of that income or taxes as well, or get you down to a 0% tax bracket, possibly even as well. Now, let's look at the next image we have on here, going over the current standard deduction amounts so we can better see that visually as well. Now, in 2025, you see in the top left corner, filing status, single, head of household, married, filing jointly. In the second column, there is the base standard deduction that we qualify for. And this example is a lot. I'm going to be going with married filing jointly as example studies on here, but married filing jointly, $31,500 you're going to utilize as a standard deduction to help offset some of those taxes from that 401k or other items in retirement, or even retiring earlier as well. Now, let's look at the next image on here, in particular with the new law that just passed on here, right? The OBBBA, and those that are age 65 or older, or if you will be age 65 or older between now through 2028. You might know someone that's really applicable for you, but at age 65 or older, each spouse gets $1,600. If both spouses are 65 or older, they get another $3,200. With the new law that just passed on here, the new bonus deduction, it's another $6,000 for each person over 65 to a total of $12,000. So in a married filing jointly situation, if they're both over age 65, they get $31,500 plus $3,200 plus $12,000 for a total of $46,700 they can utilize as a standard deduction to help offset some of the income from the IRA, the 401k, or other income sources. And if you're not age 65 or older, you still get that $31,500, which we'll be discussing more later out there on here. Now, again, what are the limitations? Well, let's look at the next chart on here on the modified adjusted gross income and how to qualify. Now, with the new additional $6,000 bonus, it's that law that just passed on here, if you are single, your modified adjusted gross income has to be less than $75,000. And if you're married, filing jointly, it has to be less than $150,000 to get that additional $6,000 bonus deduction from that law that is currently passed on here. Now, you can see that it's so important for planning using real numbers and real data, especially now through 2028 with the additional bonuses from that. Now, let's go on to what is this one big, beautiful bill act that just passed? Well, for so many that don't know, the Tax Cuts and Jobs Act passed in 2017. That was going to be ending at the end of 2025, so the end of this year, that would have had sunset, which meant was the standard deduction would have been cut in half or half the amount, and the brackets would have changed and been more taxes. However, with this bill that just passed, it's keeping the standard deduction as is, or double the way it is now, and keeping the more favorable tax brackets in addition to more, which means now you can be more proactive with all your planning and not having to worry about those changing the end of this year like it was going to be on there, which means you can do more things potentially like Roth IRA conversions depending. You can do more things like taking out more income from the IRA or 401k using that standard deduction that will be higher here as well. Now let's take this next image on here so we can see what those current tax brackets are with this act. Now, up here on the right-hand side, these are the 2025 tax brackets that will be staying. And you can see this is for your W-2 income, your IRA, your 401k, and your TSP qualified withdrawals. You have those tax rates at 10, 12, 22, 24, so on and so forth. On the far left over here, as in prior videos we've shown, this is your long-term capital gains tax rates, which are not changing on there. So we have that 0, 15, and 20%. And those qualify for the non-qualified or the non-retirement brokerage account, as shown in prior videos too. But these are the taxes for us to be aware of when we're discussing this. Now, let's go over what we call layered income strategy with early retirement or optimized retirement with having less taxes overall with some real examples on here. Now, I will be having for this first example, a couple age 65, married filing jointly with various income sources. Let's go ahead and take a look at this next image that we have on here coming up now. Now, we're going to have, for example, $30,000 from a Roth IRA. This is tax-free money. We're going to have $20,000 from a long-term capital gains in a 0% tax bracket from that prior chart. $40,000 in combined Social Security benefits, as discussed in prior videos. $20,000 from a 401k, taxed as income. $20,000 from an IRA, taxed as income. Now, if we look at the math, it's a total of $130,000 in gross income. And after they pay taxes, they're still going to keep $128,670, and their federal tax only could be $1,330. Well, let's see how. $130,000 minus the Roth IRA of $30,000 is $100,000. Minus half of the Social Security benefit amount is $20,000, example only. That's $80,000. $80,000 minus $20,000 from the long-term capital gains, as is taxed differently, is $60,000. That standard deduction of $46,700 reduces it to $13,300. And a 10% federal bracket, as example, they would only pay $1,330 on there. That's just one strategy of many for this. Now, let's go ahead and switch over to another couple. Age 55, married filing jointly. Now, because they are below the age of 59 and a half, we ideally do not want to take out money from the 401k or the IRA because that's a 10% early withdrawal penalty in addition to taxes. So ideally, we want to wait to use that money until past age 59 and a half. So let's say, like our next image on here, 55-year-old couple on here, they're only going to qualify for that $31,500 standard deduction because they are not 65 years old. Now, on this one on here, we're going to show how this couple, due to $100,000 gross income, and after taxes, they pay $0 and keep $100,000 of that income on a federal level. Let's see how. $20,000 short-term capital gains, taxed as income. $50,000 long-term capital gains, 0% from that prior chart. $20,000 Roth IRA using contributions only, 0% tax. No money from the IRA, no money from a 401k. There's no money from Social Security benefits. They're too young to claim that. And then $10,000 from the bank money or the cost basis in that non-qualified account. So we have $100,000 minus the Roth of $20,000 is $80,000, minus the $10,000 cost basis is $70,000, minus the long-term capital gains of $50,000 is $20,000, $20,000 minus the standard deduction of $31,500 nets out to $0 because you can't go negative. They're not going to pay you back money for being in the negative section on there. So now you could have a $0 or 0% tax in that situation to help you retire earlier, wealthier, and happier. Now, also, when it comes to pensions, right? State employees, military, or federal employees, that pension amount that is taxable as income. Now, that pension amount, yet again, it can be reduced or offset with that standard deduction as well. So you want to also account for that. Now, in the end on here, it's so important to understand the standard deduction when you're having your investments, 401k, IRA, your Roth, your non-qualified account, and so much more. That way you can tax optimize to take out the most money possible from those accounts, use that standard deduction appropriately, and know what your net result will be to keep more of your money. It's about confidence, it's about clarity, it's about being proactive and having education. So if you want to find out more, if you too want to retire earlier, retire wealthier, and or happier with tax optimization, you can always reach out to us at awakenfinancialdesigns.com. I would appreciate it if you would like this, comment, or subscribe so we can spread this education out there. Thank you so much.